Hi folks, welcome back. This is our midweek review. I'm going to try to get through this as quickly as I possibly can. Alright, so we have the dollar index. It has an expansion, ran a deeper run on the buy side liquidity here. This run higher was telegraphed in the New York session, and we'll take a look at that when we get into the lower time frames. Now, you've seen the trade that I showed on the YouTube channel today for cable, and we'll cover that when we get to British pound. But what led me to believe that the bias was in fact bullish for dollar, bearish for foreign currency, was the fact that we took out this high, running straight up, took this high out here, and then we had this impulsive run here. So we ran higher, creating an imbalance there with an order block. This retracement back down in during the New York session set up optimal trade entry for a run to higher time frame liquidity, which would be resting above here. Now, had this broken down lower and attacked the sell side like I was looking for initially, which did not come to fruition, it did not trade down to here. Had it broke lower, that's what we were looking for. But because it broke above this short-term high here and then showed an impulsive price run during the New York session, this is the signature you're looking for. You're looking for a run in a direction with a down close candle. This is hallmark. This is classic optimal trade entry, bullish order block, buy side balance, sell side inefficiency. Everything going for you for bias now. It's tipped its hand. On a 15-minute time frame, you can see that optimal trade entry here. So right from midnight last night, it just was a straight run higher, a drop down ahead of New York. We rallied and dropped back down in. Order block, optimal trade entry, and then sent it higher into higher time frame buy side liquidity, which is bearish for foreign currency. Euro dollar worked off of a bearish order block in here yesterday and then expansion lower. Again, had it not shown its hand overnight going into New York session, I would have expected, again, an attempt to try to go a little bit higher, which is important to know what you're looking for. And also, one of the benefits of sticking to New York session, because New York session has the added benefit of looking at what London has done. Many times you're going to have opportunities where the London session creates the best move, the best magnitude and volatility for that particular trading day. But sometimes it's better just to give that up in exchange for more clarity and more visibility that the New York session will bring. It usually won't be as volatile as this. Usually the London session creates the larger move, and then New York just continues in that. Not always, but when it does move in tandem, it generally moves with a smaller degree of magnitude that London posted. But London was a small run lower and then accelerated into New York session, as we'll see in the lower time frames. So we started to break down here overnight. Again, same thing. Sell side imbalance, buy side inefficiency, bearish order block, optimal trade entry, attacks sell side liquidity. Nice rebalance back up into here and sells off. Right from midnight, drops lower, delayed Judas swing here, breaks down New York session optimal trade entry right in here, and then breaks lower, rebalance here, institutional order flow entry drill, fair value gap, bearish order block there, small little optimal trade entry, and then breaks lower. Pound dollar. All right, so we had a run up into this level here, and I mentioned that if this is the key words here. Now go back and watch last night's video and the commentary around pound dollar, and you'll understand more as to why I elected to do what I did in cable today. This imbalance right in here, this one here extended through all the candles because we're not supply and demand, I mentioned that if we trade down below it and come back up into it as resistance, I would be interested in shorting it there with a run below this low here. Okay. Now, I'm saying that on this time frame so that when we go down the lower time frames, it'll match up to what I said last night in the video, because I did not talk about this idea here on the daily, but the imbalance is here, which we'll see on the hourly chart now here. And I mentioned if we trade down below any imbalance of any significance, really, like a higher time frame, hourly, well, not hourly, 4 hour and daily, I like those imbalances for the purpose of kind of like treating it like support and resistance, but it gives you real support and resistance versus looking at just simply an old high and old low. Sometimes they could fail to be reached too, whether it be above or below current market price, or they go through them and sweep and raid liquidity, which it blurs that line of trusting which is the proper support and resistance level. So when we look at these imbalance areas that are fair value gaps, it gives you clarity because the algorithm is rebalancing. Once they rebalance these levels and they break through them, when they come back up to them, they are treated as real support and resistance, because that's what a fair value gap is. It's providing a fair value for informed money. So we traded down below it, trade up into it here, and when we get down to the 15-minute time frame, you'll see that. It's really nice to see where the bodies reflect this premium high. And we have this imbalance here. If you extend that out in time, we go through it, come back up into it. That's also a short as well, and then it sells off. So essentially 135 big figures, good. And the imbalance premium high in here, we'll see that on the 15-minute time frame. All right, so here's the 15-minute time frame. Here's that daily imbalance. We traded down through it, came back up in. Look at the bodies respecting that, okay? That is algorithmic. That is not supply and demand. That's not harmonic. That's not Wyckoff. That's not Mr. Lowry. That's not Mr. Williams. That's not anybody else's stuff but what I've taught you. So perfect delivery of price showing the volume in the bodies of the candle. On a 5-minute chart and 1-minute chart, I was looking at this as a market maker sell model. And when we look at the lower time frame, you'll see what I mean. But this whole idea of returning back up into here, this is smart money reversal, and I'm using the low risk sell. And I know it's probably hard to see here, but when you drop down the lower time frame, you'll see it. But if you drop down to a 5-minute chart and a 1-minute chart, you'll see this is a market maker sell model. And with the low risk sell, that was my entry at a level of distribution or expected distribution. And we had an imbalance in here, trades up into that imbalance, and creates an institutional order flow entry drill. Now, if you look at the video I posted today on YouTube, look over here. You'll see the same imbalance on the downside is shown with an imbalance on the upside. So that becomes a balanced price range. So the question you're probably going to have many times when you're looking at an analysis is, when is it going to fill the gap? And when is it not going to fill the gap and create just an institutional order flow entry drill? If we have a balanced price range, if it trades back up into that level, it's going to be institutional order flow entry drill and not likely to fill the gap. That's the purpose of me teaching you balanced price range, because it'll filter out where institutional order flow entry drills are versus an expectance on your part to see whether a market trades up and fills in, or trades down in and completely closes in a fair value gap or an imbalance, or if it goes to consequent encroachment. If to the left of your imbalance we have a matching opposing imbalance, again, look at your notes with balanced price range. If those occur, then you're going to settle in with the expectation it's going to be a shallow run into that gap, not a complete closure, and that's the institutional order flow entry. And you see me annotate that live in the price action in that quote-unquote demo paper trade illustration, but nonetheless, I'm reading the tape, I'm showing you and illustrating. Folks on YouTube have no idea what the hell's going on in that video. They just like the idea that I'm getting in, they see where I got in and where it's going. And I'm annotating where the bearish order block is, it hits it and it goes lower. They like to see that stuff. You know, if you look at the 5-minute chart, 1-minute chart, strip that down into a market maker sell model, You'll see everything I teach in response to where the accumulation was on the buy side of the curve. On the sell side of the curve, all those levels become distribution levels. So that's the homework for tonight, and I'll revisit this idea on Friday. As a reminder, I'm not going to be doing a video tomorrow because my mouth was killing me all morning, and I think it's because I've done a lot of talking, and as I talk, it irritates the stitches in my mouth. So I'm trying to get through this as quickly as I possibly can tonight. But selling short here, partials, and then the old low in here, and the 134.25 level being smashed rather handsomely today, and even went a little bit further lower. NASDAQ, I mentioned, this is just a bonus tonight. I mentioned that after this swing high formed, I was looking for a reversal pattern, but not trying to capture the high. I'm not trying to pick a top or anything like that. But I mentioned if we traded lower into this area in here, that would probably be a little bit more than it needs to do for a retracement, and we might need to come back down into here. And to do that might pose a little bit more of a problem for near-term bullishness. So again, I'm not trying to pick the top. I'm just saying that it's interesting to the things I showed you and where it was likely to reach down into over here and sell side over here. It did that. And it reached down also into this small little fair value gap as well. This is a really nice technical day here, bearish order block. The imbalance here, we traded away from it, back up into it here, and then respected the discount low and bearish order block with optimal trade entry. So there's a lot of layering there of the concepts I teach you here in mentorship. All right, this brings us to our homework assignment review. This is the cotton market. I mentioned to go into your charts, look at this low here to that high here, with the framework that would cause you to expect this thing to go higher. And I got a lot of feedback over the last few months asking for these types of exercises, and the folks that have asked for it, they've been providing more feedback saying these are the things that help them learn. They can see it because it allows them case studies to go in and look at and kind of like take the pieces of the things that you learned here in mentorship lessons and then place them in here, and it's illuminating. Yes, they're old moves. Yes, this is exactly how I learned how to read price. The things that you watched me do today, the things I talked about last night on what makes the British pound a short. These things materialize today. Again, you're not going to appreciate this mentorship as much as you will if you put the work into doing the things I'm suggesting you go in and do. That's the whole purpose of these homework assignments, is to stir up the interest for you to go in and find moves. You don't need me to point them out. I'm just providing them as a means of continued stimulation, because some of you just don't want to do it. You're lazy, or you just don't know which ones to pick because there's so many markets to choose from, so many different time frames. So I'm taking you into a segment of price action that I want you to strip down and figure out why these things were salient. You don't need to apply everything. And that's one of the benefits of doing this, and it's liberating for the folks that are doing this. They're like, wow, I don't need to force every single component into this. And they start growing an affinity for certain tools, and when those tools speak to them in the technicals, that's their model. And that's what happens by doing these types of exercises, because it provides you a means of not only learning deeper and exercising your memory of what you understood and learned thus far, and applying it to a move that absolutely has happened. You can't be influenced by greed because you can't trade it. You can't be influenced by fear because you can't lose in it. So you're getting all the benefits of studying, and your brain is remembering these as pseudo experience, and that pseudo experience will materialize in future price moves. And that's the way it's done. There's no shortcut to it. There's no secret recipe. There's nothing I'm hiding from you or keeping back from you that's going to make it any easier. That's just the way it is. And the folks that are here that are doing very, very well, the students that are in this mentorship, and even the folks that aren't in this mentorship that have just studied the free stuff on YouTube, that are going out and getting funded. I don't do audits on whether they're trading profitably or not. I'm just getting the feedback that, yeah, I'm funded now. I'm doing this. Thank you very much. and this is what I'm making. This is what I made over here. Will they continue for 6 months to a year, 5 years from now doing that? I don't know. But they're doing it and they're attributing it to the work that I'm teaching you to do here. So while I can't guarantee your profitability, I can guarantee your understanding is going to drastically improve, and your ability to read the tape and read the marketplace real time before it happens will be night and day different before you started training with me versus once you warm up to the idea that every single day should be a practice session for you. Find an old move, even if it's something hindsight. I know some of you are desk jockeys or running your own company or whatever, students. When you come home and you have the opportunity to go back and look at price action, even if it's hindsight, it doesn't matter. It does not matter, because if you were learning this from a book that I wrote, you'd look at all hindsight chart moves, and that's the way you'd be learning, right? So remove all of that stuff, that stigmatism that finds its way in, oh, you have to do it with live trading. Or look, I prove it to you guys here all the time. I tell you what I think is going to happen, and for the most part, it unfolds. When I'm unsure, I'll tell you that. And when I'm looking for something to pan out that would give me a bias, perfect example last night with cable, I'm telling you what it requires for me to find a bias to go short or go long, and what would be the catalyst for that. And you watched me execute on that today. Well, the whole world really watched me over there on YouTube, but you had the benefit of knowing the framework of why it would do that. And you all had the opportunity to see the precision element to it. And it just was this beautiful display of institutional order flow. But anyway, get into this so I can get done. This low to this high. You want to go into Trading View and pull up chart CT number 1 exclamation point. What that's going to do is it's going to draw the nearest contract for cotton, because this is a commodity market, and it's going to basically compile and compress all the near-term nearby contracts before they expire when it has the maximum open interest. I'm assuming that's how they're doing it. And it plots that price on a cumulative basis. So this chart is always reflecting the nearby contract fluctuations in price. If you go back here, all the way back into, I guess that's 2011, we have a breaker here. High, low. I had to scrunch this thing up to show it on the weekly chart, but here's the high, the low, and the higher high. That down close candle and extending it out in time. So here's your premium array. And here is that low that we're going to go back to on the daily chart in a moment. But notice also we have a low, high, lower low. This is a bullish breaker. And it's also low, high, lower low. This is your bullish breaker in here. So there's lots of levels in here to anticipate accumulation on the long side on a macro level. Okay, so you're going to be looking for reasons that the institutional investors will be wanting to buy up any accumulation that takes place around that 88 to 90 level. And again, the reasons why is this bullish breaker, this bullish breaker, and we drop down. Okay, we drop down to get a discount. We go back into the daily chart. That's what this is here. This is that run and drop down. Big beefy candle, that's your bullish order block. Extend it out in time. It drops down in. Optimal trading tree would be from this low to this high, and we'll look at that on a 4-hour chart. But the accumulation is seen here, and dynamic rally. I want you to think about, why would the price react that way? Why is it so sharply higher? Not just a lethargic or a slow, steady run. Why is it so snappy higher? Why it just goes and runs? Well, go back over to your barchart.com when you pull up the cotton market, and you'll see, you don't look at this, it's the cash price. So nearby contract at the time of this recording, which is November 10th, 2021, is the nearby contract, December 21. Okay, 2021 rather. And its price is listing at 118. And then March is next month out, and it's 115. And the next month out after that is May 2022. It's 113. Notice that we're seeing higher prices right now, and it gets cheaper as it goes around into the future. That's an inversion. That's backwardization. When that happens, this is a premium market. That means that any bullishness is likely to see this type of price action where it's very, very abrupt. It's sudden. It's sharp. It covers a lot of ground real quick. That is a commercial bull market. Okay, this is what I learned from Larry Williams, and it still holds true today from that 1970s book, How I Made $1 Million Trading Commodities Last Year. If you don't have that book, just get it. Okay, it's a gem. A lot of things in there are silly when it comes to like the moon phases and all that stuff, but when it comes to his $1 million tools, the open interest, the premium, which is this, don't be confused with this being premium discount. This is a premium in its pricing in relationship to the next month out. So while the term is the same, the idea of how I teach discount the premium for the PD array matrix, that's not what I'm referring to here. The premium is the premium over the next month out in the future, when it should be getting higher in price as you go further out, because it costs more money to insure the commodity, to grow it, produce it. It's just more expensive. That's the normal carrying charge market. And also, if you take a look at your seasonal tendency, for the folks that have the benefit of having gotten this far in your studies on month 10, if you go into the commodity portion of month 10 content and seasonal tendencies, you'll see that in the month of September, the very last week of September, thereabouts, and the third week of November, thereabouts, those are seasonal lows for cotton. And look what cotton does. Well, here's the last week or so of September, which is what you see right here. Boom. Now you have that in combination with a premium market in the pricing of each contract month, because commodities and futures, they expire. They're not like Forex where it just trades in perpetuity. You have to know when to get out and roll into the next month, or completely get out and just don't be in the market anymore at the time. So this market had a lot of things going for it, because it was already in a bullish market from March 2020. Go back and look at your historical chart. That CT number 1 exclamation point. That's the nearby continuous chart rather. And it gives you a long-term historical perspective. And you can see that we've been very bullish, especially since March of 2020, like most of the commodity markets I mentioned. And because it's in a bull market, and then we went to a premium relative to its contract month pricing. Then we entered a seasonal time of the year, which when I'm teaching about this market in the lessons in month 10, I actually talk about how this is a really good seasonal tendency that does very, very well in the fall. So if you want to trade cotton, what's a really good time to be a buyer? September, November. When you want to be a short seller of cotton, in the springtime going into the summer months. So that's the benefit of knowing commodities. If Forex gets completely decimated, say one world currency comes, and my faith, in what I believe is going to happen to me, is delayed in terms of what I believe is going to happen. And I'm not trying to preach to anybody. I'm just saying, if I have to be here longer, that allows me to see an inevitable one world government, one world currency, these commodity markets are going to still be trading, because there's going to be commerce, there's going to be businesses that need these types of things. So if currency is not the way to make money, the futures market will be what I go right back to. And it's always going to be something for me to be trading. Okay. And the question is going to be is, if you don't get the vaccine, if you don't get the this or that, you may not be able to trade. I have friends, I have associates that have unfortunately taken that stuff. And I'm not against making partnerships with people, so that way my skill set allows them to do well and they help me. So that's the freedom in all this stuff. It gives you a way to sleep at night. I know some of you are worried about losing your job because you're being asked to either, it's not really an ask. It's not a choice. It's take it or you're getting fired. That's an ultimatum. That's not a choice. But for those that are here that are facing that, the skill set you're learning here hopefully will deliver an opportunity for you to find a way to, at the very minimum, ease the anxiety about that. And while I'm not guaranteeing any of that being so, I know that it was a constant reassurance on my part when I was coming up, when I was working 13 hours a day, doing stupid jobs. I believed and had faith that this whole idea of market technical analysis and all that stuff would some way, shape, or form deliver me out of all that stuff. So I don't know how long it's going to take for you, but it took me a longer time than obviously I expected and wanted it, but I wasn't letting go like a pit bull in a pork chop. And in the 4-hour chart, the optimal trade entry, low to high, you can see we traded right back down into almost the 70.5 level. I'm going to guess it looks like it's close to it, but even if it doesn't get there, it's okay. We're on the side of our range. Small little fair value gap on top of that. The projections above, standard deviation -2 above this high, and there's a reason why you'd be taking that out also with that weekly bearish breaker that I showed you at the beginning of the discussion for cotton. And that, my dear friends, is going to be it for tonight. Again, as a reminder, I am not going to be doing a video tomorrow. I need to rest because I can already feel my lower jaw aching. So I will be talking to you this weekend. If I do not have the video up by Friday, do not be alarmed. I will have it up certainly by Sunday at noon my local time. But I'm going to be obviously aiming to get it up by Friday because I want to be able to enjoy the weekend and rest as much as I can. Until I talk to you on Friday, be safe.